If you ask a lot of people who have never invested before, they will tell you that investing is easy. You buy low and sell high, and the difference is your profits. However, if you ask someone who has been around the block, you'll get a different answer. The founder of the largest hedge fund in the world, Ray Dalio, in a recent Reddit AMA had a powerful message to amateur investors. He said, "I believe that competing in the markets is more difficult than competing in the Olympics because there are more people trying to make money doing it, and it's a zero-sum game. Yet, most people think that they can do it." In fact, he's not wrong. When you invest or trade in the financial markets trying to make some consistent gains, you are literally competing against some of the largest organizations and some of the smartest people in the world. These organizations include big banks, commercial or mutual funds, hedge funds, pension funds, and insurance companies. These companies have means and resources to gather the best information to make the best investment decisions. On top of that, financial sectors attract some of the best talents. There are top accountants, analysts, scientists, and mathematicians working day and night to outsmart everyone else, including the retail investors, which is basically us. When I first started investing in the equity markets in the US with a very amateur mentality, I lost around $7,000 in my first month. And remember, this was 4 or 5 years ago. Then I started revenge trading to recover that money back, and I lost a total of $20,000 in the next couple months. It was painful for me to lose that amount in such a small time, as it had taken me much longer to save it. I wanted to quit and call it good, but then I realized that there were people trading in the same market who were making consistent returns, and some of them even went on to beat the market and were able to do that consistently. I thought to myself, if other people can do it, why can't I? Soon after that, I understood that the reason that I had lost that money was because I was playing a game that I did not take time to learn. Honestly, that was it. I was one of those amateurs who think that investing is fun and easy and they are super smart. I wanted to call it quits because I had lost a lot of money on a couple trades. But then I realized that there are highly experienced people who lose money too. No investor makes profits on every trade. There are winning trades and there are losing trades, but good investors make more winning trades and less losing trades. I wanted to make investing a serious side gig, but I simply wasn't sure where to start. This drive in me prompted me to start reading books. Actually, lots of them. I read about 70 books related to money, and about 30 plus books from there were on the topic of investing. Learning from these books and several online resources, I got a deeper understanding of how market works. I learned about stocks, bonds, currency markets, repo markets, and so on. I also understood the role of central banks and different government bodies, which puts a direct impact on the economy, eventually impacting asset prices. I also learned the strategies that investors with track records, such as Warren Buffett, Peter Lynch, Charlie Munger, Bill Ackmans of the world were using. The best way to learn their strategy and trading mindset is to read their books, biographies, and see why they think the way they think, and how you can get into that winning mindset. I've compiled a list of my top 10 most favorite books on investing in the description below, so please feel free to check it out and see if you want to read any of them. I made a video last week explaining what I learned after reading 70 books on money. So those are basically things that I learned regarding money. It's not about investing. So that's why I actually wanted to create this separate video on investing. If you're interested in that video, please check it out. It should be somewhere in my channel. For this video, I've compiled everything that I've learned reading all of these books and summarized them in top 7 rules. So without further ado, let's dive into these rules. Define an investment strategy. You have to define a strategy that you will follow to make your investments. Investment or trade that you make, you have to define ahead of time whether you are going into that stock as a long or a short or both. You should also define the time horizon of these investments. Are you going to hold it for an extended period of time, like 5 years or 10 years, or are you going to sell it after the next 6 months? Your investment strategies should be tried and tested. You can test your strategy doing doing paper trading for a period of time. And if your strategies does not work while paper trading, you should understand that your assumptions were not correct. You should keep tweaking your strategy until you start seeing some consistent returns. Once you have a winning strategy, start small, and this time with real money. The reason I ask people to start small even though their strategy seems robust is because you don't really deal with the same emotions while paper trading the way you do when real money is involved. So there is still a chance that your strategy might not work. Manage your emotions. Fear and greed are the two most powerful emotions at play in the financial markets. When the prices go up, people become greedy and wait for it to go higher so that they can maximize their profits. Whereas if the prices go down, they get afraid and they sell to stop the losses further. You can actually see the current fear and greed index on CNN Money website. If not managed well, your emotions can stand against you as your biggest enemy in the path of your success in investing. You should command these emotions and stick to your plan and strategy. Take calculated risks. Investing in any kind of asset, whether it is equity or currency or real estate, there is some risk attached to it. However, if you're not taking calculated risk, you are pretty much gambling at that point. Now, risk can be of various types, from high risk to medium risk to low risk assets. Generally, the law of risk is that higher the risk, higher the reward, and vice versa. How much risk you should take depends on your financial standing and also your age. Generally, it is advised that younger person can go out in the market and buy riskier assets that might prove out to be really profitable when the prices go up. However, people who are beyond certain age, like let's say 55 or 60 or even 65 for some people, they would actually be better off investing in assets that are not very risky, because at that point in your life you have too much to lose compared to some young person out there who does not really have too many responsibilities. Diversify your portfolio. Please do this. This is something that I have learned the hard way. Now, there are always some company that you know about the most or the sector that you are really familiar with. For me, that is tech stock. Me being an engineer, I work for a big tech company that works with multiple other big or small tech companies. So it is easier for me to understand how these companies operate, what are the risk factors, and so on. However, I take time to learn about other sectors. For example, I learned about real estate investing on my own. I learned about cryptocurrency, gold, oil and gas, and so on. Remember, first you learn and then you earn. I actually keep repeating this sentence because learning has really helped me in the markets. Diversification helps you become a better risk manager. If you're seriously investing and considering it as a business, then what you are is a risk manager. Well, welcome to the club if you didn't already know that. If you put all your capital to one company or one sector, if the sector or that company outperforms, you'll make a lot of money. But if the sector or that company goes down, you'll actually end up losing a lot of money. And you ending up losing a lot of money happens more time than you making a lot of money. If you are betting on a certain company or a certain sector, you should diversify your portfolio over several sectors, and then you should diversify stocks or bonds within those sectors too. If you're buying tech stocks, Amazon should not be the only equity in your portfolio or in your tech portfolio. You should spread your capital over other good companies within tech, such as Google, Facebook, Microsoft, or any other company that you find with growth potential. You should not have more than 20% of your portfolio in any one of these sectors. There are 11 sectors in S&P 500, and they are following: communications, consumer discretionary, consumer staples, energy, financials, healthcare, industrials, information technology, materials, real estate, and utilities. Dollar cost average whenever you get a chance. What do you do if the price of the stock you own goes up for some reason? You either sell and take profits, or you hold on to it in anticipation of the price going up further. But what do you do if the price goes down? If you have bought the company after a thorough research and you know that the company is not going bankrupt, and you see the price drop as a buying opportunity, this will increase your holding but bring the price per share down in your portfolio. For example, let's say you bought 100 stocks that cost $2 a share, and now the price goes down to $1. If you added 100 more shares, you'll have a total of 200 shares with an average price per stock of $1.50. However, this strategy should not be used while trading penny stocks or any of the other volatile assets because there are way more higher chances of downsides. Institutionals and experienced investors practice this method all the time in the markets. One thing I would like to mention here is that to buy when the market drops, you need to have some cash balance. So always make sure to keep some cash in your trading account to grab the market opportunities as such. Do not go all in with your money. Start by adding small positions and grow your account slowly. There is nothing wrong with that. There is no hurry in markets. You don't have to be a millionaire overnight. You can do it slowly, gradually, and then making consistent positive returns. If there is anyone that tells you otherwise, ask them to go talk to me. Invest in what you understand. A lot of people actually suggest this. A good profitable investing business is dependent on quality of decisions taken at the time of buying or selling. You'll be able to make better decisions about a topic you know very well about rather than a topic that you don't know very much about. So my approach in this case is, if I don't know much about a particular stock or a particular sector, I start doing my own research about it. A year ago, I was interested in learning about Tesla stock. So I went ahead and tried to learn everything I could about the company, the competition, and the global auto demand. And this helped me make a decision whether I should invest in Tesla or not. Start as early as you can. Investing works the best over a long period of time. The S&P 500 index is a benchmark of American stock market performance dating back to the 1920s. This index has returned an annualized average return of around 10% since its inception through 2019. It does not really pay to wait. For an example, if you invest $25,000 in an investment that gives you the compound interest rate of 10%, in 40 years you will have $1 million. This is by the power of the compound interest. So if you were 20 when you made the investment, by 60 you could become a millionaire. However, if you made the same investment when you were 30, you will only have $436,000 by the time you are 60. So that's why I can't stress this enough to young people to invest as early as they can. That's the 7 rules of investing that I came up with after reading 50 books on investing. Please let us know in the comment section what are your rules of investing and help the community grow and learn from each other. If you found any value out of this video, please like and subscribe so that YouTube algorithm can show this video to more and more people who might really need it. As always, thanks for watching and I'll see you next time.